3, 2, 1, and 0, and liftoff.
Hey everyone, it's Greg Lafferty, the Rocket Guy, and you're listening to the Rocket Guy Real Estate Investment Network. Come check us out at therocketguy.com, where there's plenty of extra resources to help you along your way of your real estate investing journey. And come check us out there and like and subscribe and do all those kind of things we need to do here as well. And we're going to jump right in this today. So last time we talked about some terms that we usually use for real estate investing analysis, especially in the commercial side. We talked about capitalization or cap rate. We talked about cash on cash return, and we talked about debt coverage ratio. And we just kind of defined the terms a little bit, because if we don't have a definition of terms, how can we communicate, right? It's all about the communication in life. Life's a team sport. We have to be able to talk to each other. And so we kind of define the terms. Well, today I'm going to try something totally different. We're going to try to dig into the math a little bit here. This is going to be hard, okay? We're going to deal with addition and subtraction, which is addition's tricky friend, okay? And but it's a little difficult always on these platforms just to kind of be able to do math and kind of walk through things. And I can't see the feedback of everybody as they're glazed over and say, Greg, this is boring. I hated math in school. Why do I have to do math? Well, if you want to invest in real estate, you got to do at least a little, okay? You could go in there and just feel it if you want to. I feel like this is a good deal. But then when you go borrow money, you probably need to do the math. So let's kind of walk through that a little bit. I'm going to try to pull up the PowerPoint that I use and just kind of walk through it and walk you through some examples and kind of walk through the definitions a little bit again and dig into it. So let's talk about that. So usually when we're talking about analysis of rental property, we think in terms of income and expenses, and we see the income and expenses on what we call a financial statement or an income statement, okay? Profit and loss statement. There's different terms out there, but basically a basic financial statement, and that usually deals with income, less expenses, operating expenses, okay? How much does it cost to operate the property? Taxes, insurance, maintenance, vacancies usually in there, all that kind of stuff, to get to a bottom line of a net operating income, NOI, okay? Everybody's like, what's your NOI? So that's my net operating income. Income's very, very simple in a rental business. It is the rent. There might be other income out there, right? You might have a laundromat. You might have vending machines, late fees, other things like that might go into it, pet fees maybe. But in general, it's all the components of income. And then you're subtracting out all the components of expenses. Now, not the debt. That's not an expense. Okay, that's a little different. Okay, it's a little different. Just the operating expenses. How much does it cost to run the property? So let's assume I pay all cash, okay, for this example. You accountants out there, no, it doesn't include depreciation, okay? We're not getting that deep. This is not tax stuff. This is just operating income and expenses, okay? So income minus operating expenses equals the net operating income. Get it? Okay, cool. Because that's the foundation in which we're going to build to kind of dig into some of these formulas. So we talked a little bit about last time about the capitalization or the cap rate. And the cap rate is, what if I paid all cash for this property? What's my rate of return? Okay. And so if we kind of look back on this kind of basic financial statement, we have income minus operating expenses equals the net operating income. Well, then we have everything we really need, almost, to calculate the cap rate, right? The last piece we need is, what's the purchase price, okay? And usually when we look at this initially, it's the full price. It's what the sellers are advertising, what the brokers are advertising. Here's how much it costs to buy this property. Now, your real cap rate will be what you actually paid for it. So there's some negotiating in there and that kind of stuff. You might even roll in some of your closing costs and other things like that just to get your what you actually paid, okay? But the cap rate then is, you take the net operating income, easy for me to say, and you divide it by the purchase price. And when you do that, voila, you get the cap rate, okay? But Greg, you have to multiply it times 100. I know it's a percentage, okay, but like, let's get easy with it, okay? So let's run through a quick example here, okay? So what if I have a property that's generating about $55,000 in income a year? This is all annual, okay? It's all annual, maybe has just over $20,000 in operating expenses, not the debt, just operating expenses, taxes, insurance, maintenance, vacancies, those kind of things. It has an operating expense of about $20,900. Okay, to get exact. This is an example I worked out. Okay, so based on a property I bought, and so the net operating income is $34,100. So if I were to pay $450,000 for that property, then my cap rate is $34,100 divided by $450,000, and that gives me 7.58%. So if I were to spend all cash and put $450,000 into this property, then I should expect my cash flow, my net operating income comes into my pocket of 7 and almost a little more than 0.5%. Okay, not a bad return. It's not something you just high five at the bar at at Friday at 5 o'clock about, but it's a decent return, right? Better than putting your money in a CD or a savings account. So 7.5%. So I hope everybody kind of understands that. That's the cap rate. So it's the net operating income divided by the purchase price, cap rate. So if we take a look again at this basic financial statement where we had income minus operating expenses equals the net operating income, if we then remove from that amount the annual debt payment, right? So much a month times 12 months, the annual debt payment, that gives us our cash flow. So if we're going to get a loan on this property, then we're going to have some debt. So how much after I pay for the debt is going into my HIP National Bank? Okay, that's what we're trying to figure out. That's my cash flow, my annual cash flow. Do we want cash flow? Absolutely. Okay, because that's what we're about. If you don't have cash flow, you're going to die. Okay, financially, not really. So you'll just be hungry. So anyway, so we want cash flow. So if we take that again and look at the next financial term, which is cash on cash return. So this assumes that we have some kind of loan on the property. Cap rate is I paid all cash. Okay. And that's used mostly to evaluate one property to the other. But when you're getting into these details, you're actually assuming how much you're going to put down, how much debt you're going to have, what kind of interest rate it's going to be, all those kind of components. So the cash on cash return is same kind of thing. You get to that cash flow number and then you divide the cash flow by the initial investment. And that is your cash on cash return. So if I put this much money in, I get this much money out. That is my cash on cash return. Okay. And so, every lending package will have some different requirements based on the property class and your purchasing ability and all that kind of stuff. So for purposes of this analysis, we used a 20% down kind of flow. And so let's walk back through the same property. So if we had a $55,000 income, $20,900 in operating expenses yielded a net operating income of $34,100. I had an annual debt payment of $25,054, okay, which gave me a cash flow of $9,000 a year, right? I put 20% down on a $450,000 property. So that is, voila, $90,000. Okay, that's 20% down. And so that gave me, if I take the cash flow divided by my down payment, cash flow divided by my initial investment, 10%. Better return on my money. So initially I had about a 7% return if I were to pay all cash. But because I decided to use debt or leverage, right, my return actually went up. And now it's up to 10%, okay, because I'm making money on the bank's money. Okay, I borrowed that money at like 3.5%, okay. I'm earning about 7% on their money. So now my average blended rate of return based on the debt as well as the money I put in is 10%. And that's what we call cash on cash return. So if I'm looking at my return, what I kind of calculate, how I'm returning on my investment, the cash on cash return is kind of how I look. Okay, that's where I look at. So let's talk about the last number. And the last number we discussed was the debt coverage ratio. Okay, here again, we're going to use the same information that we used for the cap rate and the cash on cash return. We're just going to manipulate it a little bit differently. So if we go back to that income statement, we have income minus operating expense gives me my net operating income minus the annual debt payment. There's my cash flow. Okay, pretty simple. Now, I'm not going to go all the way down to the cash flow. I'm going to stop kind of in the middle because the debt coverage ratio is really providing the lenders comfort that you're going to have enough income above and beyond the debt payment to make them feel comfortable. Okay, and most lenders want a debt coverage ratio of 1.2, 1.25. Okay, meaning they want 20 or 25% more income coming in than the debt going out. Okay, so let's see how this deal worked out. So the way you calculate that is you take the net operating, how come I stumble on this? I don't know. The net operating income, I've been saying this for 25 years, I think I get it right. Net operating income divided by the annual debt payment is the debt coverage ratio. Now, this is not a percentage. This is just a multiplier. Okay, so it's not a percentage. So in a percentage, remember back to high school, elementary school math, right? You got to multiply by 100 to get the number. Okay, you could do that, and we could put that in there if you really want. Can you get picky? But I think you're smart, so you can figure this out. So in our prior example, remember we had a net operating income of $34,100, and we had a debt payment of $25,054. And so if we do that math where we take the net operating income and divide by the annual debt payment, so we'd have $34,100 divided by $25,054. You see in this particular deal, we had a debt coverage ratio of 1.36. Well above the 1.25. So we have 36% more income than debt payment, which is fantastic. So let's think about that. So overall, as I would look at this deal, I would sit there and go, okay, that's pretty good. So I might dig in a little bit deeper and say, okay, well, how firm are the leases? You know, what kind of terms are in there? What's the quality of the tenant? Do I think they're going to pay? Is the maintenance good, or, you know, is the building half falling down, or am I going to need to put a bunch of money into it to bring it up to keep the tenants, or maybe to turn it over and attract new tenants? So there's a little bit deeper level of analysis, but just the basic fundamental financial analysis, this looks like a pretty good deal, right? My cash on cash return is double digits. That's a big win for me. So I crack over 10%. I usually get a little happy. Okay. The cap rate's not bad. But I'm really looking at that cash on cash return, and the lenders are going to be happy. There's plenty of cash flow, and the debt coverage ratio is pretty strong at a 1.36 compared to what they would normally want at a 2.0 or a 1.25. Okay, 1.20 or a 1.25. So all this looks like a pretty decent deal, and in fact, I bought it. So so it makes pretty good. So it was a good opportunity. So and you can see that there is cash flow in there, right? So for that investment, then there's extra money coming in every month to our income, and that's very, very helpful. So that's kind of what we look at. So I hope that wasn't too confusing. I know it was a little quick, but we're trying to bite these little math pieces off in chunks, right? There's no need to just overwhelm you with a bunch of complicated formulas. And these aren't complicated. These are pretty simple. A little bit of division, a little bit of addition and subtraction. Nothing. We are not launching rockets, okay? Not doing calculus, differential equations, and that kind of crazy stuff. Just like, you know, addition and subtraction. You know, tricky. They're for tricky friends. So anyway, so I hope this was understandable and simplified, so that you can kind of get a grasp on what it is and how to calculate it. And of course, the components of those, all the different numbers that go in to get to the expenses, and how you're kind of approximating that, and getting to that net operating income, and how to actually calculate a monthly payment, some of those kind of things. That gets a little bit harder to do, but on the surface, you know, this is just kind of brushing over the surface a little bit to give everybody some exposure. So thank you for taking the time to join us today. I'm Greg Lafferty, the Rocket Guy. Like and subscribe, and leave some comments, and ask some questions, and do all those kind of things so we can interact a little bit together, and I can stay up in your feed, and you can get some more lessons, and kind of take advantage of the 25 years or so of experience I have in the real estate investing world. And we look forward to seeing you real soon. I hope you have a great day.